Inflation is up, the stock market is down, and at the time I'm recording this, experts are debating whether or not the US has entered a recession. Times are tough, but I am here to help you get through it. I'm Britt, your favorite YouTube money coach, and given the significant downturn in economic activity and the possibility that the US will enter into a recession this year, if it hasn't already, I wanted to take some time to explain exactly how to make money in a recession and how to avoid losing money on your investments if you're already invested. All right, let's start with some basics. What is a recession? A recession is a, quote, significant, widespread, and prolonged downturn in economic activity. Now, if that sounds vague, it kind of is. There are actually no defined boundaries or a specific formula for declaring a recession, which is why we're currently in a debate about whether or not we're in a recession. There are a few indicators of a recession, though. They are slowdown in consumer spending, spikes in unemployment, and slowing in manufacturing activity. The National Bureau of Economic Research, the governing body that officially declares recessions, evaluates 3 criteria in their recession definition. The first is depth. So this looks at unemployment levels to measure how many workers are impacted by an economic downturn. Then diffusion. This is how many industries are affected by an economic downturn to measure how widespread the recession is. And third is duration. Measures how long an economic downturn lasts before experiencing expansion. So back to your burning question. Is it possible to make money in a recession? Well, there's no simple answer to this question. Realistically, if you're already invested, you may lose money during a recession. But you can still make strategic money moves that will set you up for long-term financial success. Let me tell you how. So here are some strategies for making money in a recession. First, I want to start with a few things not to do during a recession. 1, don't panic. A recession is normal. Boom and bust are parts of the economic cycle. Between 1960 and 2007, there were 122 recessions that affected 21 advanced economies, roughly 10% of the time. The recession will pass. In fact, since 1900, the average recession has lasted 15 months. In the meantime, come to terms with the fact that your investments probably won't be doing well right now. Let go of the expectation that you'll be building wealth right now and trust that you're setting yourself up for long-term financial success by not panicking. 2, don't sell your current investments. Recessions and drops in the market tend to go hand in hand. And when the market drops, people often pull money from their investments. But this is the biggest investing mistake that people tend to make, is pulling their money out when the market goes down. They panic and they sell their investments at a loss. We saw it during the 2008 recession. When the stock market dropped, people sold their investments. And it's truly the biggest investing mistake you can make because historically, the stock market has always recovered. So if those people had just held on to their investments, they would have made huge returns instead of selling at a loss and having no chance of making their money back. This is also why we talk about the importance of saving an emergency fund before you start investing. That way, you have your emergency fund to rely on if you lose your job, and you don't want to have to pull money out of your investments in order to cover your expenses. You don't want to be stuck having to take money out of the stock market if you don't have to. If you want to learn more about emergency funds, we have a great video on that, so I'll leave a link in the description below. Third, don't try to time the market. Timing the market is extremely difficult, and very few people do it well enough to gain any sort of advantage. So, if you're excited about the possibility of buying into the market when it's at a low, I don't recommend just holding onto your money and waiting to see how low the market gets. Instead, I'd recommend a strategy called dollar cost averaging, which I'll explain more in a minute. All right, if you're still with me and excited to learn about how to invest in a recession, be sure to give this video a thumbs up, or better yet, leave a green heart emoji in the comments. Moving on to the things that you should do during a recession. 1, this is a mindset piece. Think of this as an opportunity. Prices are lower, so you can buy investments for cheaper. And it's actually a golden opportunity to get into the market at a lower price point. So if you're sitting on extra cash right now on top of your emergency fund, now is a great time to get it invested. 2, try dollar cost averaging. So dollar cost averaging is when you decide you're going to invest a certain amount of money, regardless of what the market is doing. So for example, let's say you have $1,000 you want to invest. If you don't feel comfortable with where the market is right now, then divide that $1,000 into 4. So you have $250. And every month for the next 4 months, invest $250. Whether the market is up or down, just pick a date in the month, like the 15th, when you're going to invest that $250 no matter what the market is doing. This is a solid investment strategy because you'll be consistently investing either as the market drops or as the market's going up. But let's say that the market's dropping for 3 months. Then every month, the price that you're getting in, the price of stocks will be lower than the previous month, which maximizes your return in the long term because you have more potential to gain. This also helps you get over the fear of when to invest, because people who are trying to time the market constantly worry about whether now is the best time to invest or if they might get a better price next week or next month. But when you do that, you really delay investing. Often you delay it much longer than you are planning to. So instead, by committing to a specific day every month that you're going to invest, you can free yourself from the analysis paralysis and create a healthy, effortless rhythm of building wealth. 3 is invest in real estate. So the passive income that comes from real estate investing is consistent, even during a recession. After all, it's a necessity. No matter what is happening with the economy, people need a place to live. So that means that real estate investments are less volatile and guaranteed to give you a profit. Now, if you can't afford to buy a rental property or don't want the hands-on stress of being a landlord, you can consider investing in real estate investment trusts or REITs. These are companies that manage their own property portfolios, and you can buy in for the cost of a share instead of the cost of a down payment. 4, look into I-bonds. I-bonds are a type of US savings bond designed to protect the value of your cash from inflation. The interest rate is partially determined by the rate of inflation, which changes every 6 months. So every May and November, the US Treasury Department evaluates the current state of inflation and sets the inflation rate based on the Consumer Price Index for all urban consumers. Basically, the higher inflation goes, the higher the rate of return on I-bonds. At the time of recording, the interest rate on I-bonds is 6.89%. This will likely decrease as inflation slowly comes down, but I-bonds still provide solid protection against inflation and are definitely an investment worth looking into, especially the next time inflation rises. 5, put your money into CDs. CD stands for Certificate of Deposit, and it's a low-risk savings tool that can boost the amount that you earn in interest while keeping your money invested in a relatively safe way. So like a savings account, CDs are considered low risk because they are FDIC insured up to $250,000. However, CDs generally allow your savings to grow at a faster rate than they would in a savings account. So by putting your money into a CD, you're guaranteed to at least make a return of about 2%. Keep in mind that when you put your money into a CD, it's locked up for a set amount of time and you can't get it out. That means it's crucial to have an emergency fund in place before you do this, so that if you suddenly have an unexpected expense, you have the money on hand to deal with the crisis. The other thing you can do is keep your money in a high-yield savings account. At the time of recording, there are plenty of online savings accounts with interest rates of 4% or higher, so that's a great way to just keep your money and let it grow a little bit rather than in a basic savings account. All right, to close out, the thought of a recession, it's scary, but it doesn't have to be a significant financial setback for you. In fact, you can use it to position yourself for financial success in the long term. If you want more free resources for successfully navigating economic uncertainty, subscribe to our newsletter. Every Friday, we send out advice for up-leveling your finances and updates on what's happening in the personal finance world. I'll leave a link where you can sign up down below. And if you enjoyed this video, please hit the like button and subscribe to our channel. It's an easy way to support us so we can continue to make great free financial education and content for you. Thanks for watching.